So the Youngstown Business Incubator is right across the street, right across the parking lot from America Makes. As advertised here, we have programs specifically to support incubation for advanced manufacturing and specifically additive manufacturing companies, and have a portfolio in Youngstown of about 10 companies that we're working with. The challenge, as we see all the time for our young companies, is funding and capital. And it doesn't matter where they are in the process. It doesn't matter who they are. The conversations always circle back around to how can we move from step A to step B, and when can we get some investment dollars to take us to the next step. So we should have a great conversation today about the different types of venture capital, as well as challenges and just how to set expectations for what's going to happen. So welcome everybody. As we talked about earlier, my plan is to introduce you individually, and then as we introduce you, you each have some areas of expertise. Feel free to jump in on somebody else's topic if you hear something that you want to talk about a little bit more. But if nobody has anything that they want to start with, we'll just jump right in. And Ernie, I'm going to introduce you first and jump in with an explanation of venture capital. So as I mentioned previously, YBI is a pretty diverse economic development organization. And one of the things that we've done in the past is work with Ernie Knight, YSU, Bright Energy Innovators on the development of a micro venture capital group called Valley Growth Ventures. And Ernie Knight is the managing director and CEO of that program. So Ernie, can you help everybody understand just from a high level, what is a VC group and how is it different than other types of investors?
Sure. No, well, thanks for the intro, and appreciate the opportunity to to be a part of this. I mean, venture capital is different from sort of, I guess, other vehicles in that, first and foremost, it is return oriented, and venture capital funds are managed by someone like myself, but they represent a group of other investors, and those investors have created a pool of dollars that is, meant to be distributed and invested under certain parameters. In VC, it's typically startup companies. Now, those startup companies can range all the way from, pure startups, that we call the seed stage, all the way through later stage. Think of it as pre-public offering, or, perhaps could be even profitable at that point, but very significant revenue. And it really runs across the spectrum. But what makes VC, I guess, stand out is, one, it's absolutely return oriented. And two, you tend to get really the professional investor, right? People who do that for a living, and they represent professional investors for a living. So processes and expectations are, kind of very systematic and very business oriented, and very tried and true in terms of things that have been handed down and learned through various years. So hope that's helpful.
I think so. Anybody else in the group want to add anything to that? Any nuances there? All right, moving on. Jim Hart is the president and CEO of the HBS Group, and is also involved with an Appalachian investment group trying to help bridge some of these gaps as well. Jim, we hear the term angel investor network thrown around pretty loosely. And in our world, adding to that, I think there's often confusion between VCs and angel investors and where that interplay happens. So can you help everybody understand the difference between the two?
Absolutely. So if you want to understand angel investors and their mentality, we are, in essence, front-running venture capital. Now, what do I mean by that? That means that I'm betting at a very early stage, with a total absence of data, that people like Ernie are going to double down on my early stage bet in a particular company and help take it to a liquidity event at the end of the company's maturation. So sophisticated angels are doing venture style due diligence, but they don't hold companies to venture style standards with respect to where you're at on top line, bottom line, and then maybe your technology maturation. So we're going to come in really early, but we want to see a very clear path for how people like Ernie and Valley Growth and other private equity potentially on the back end are going to come in on top of our capital and help create winning opportunities.
All right, very good. Anything else from the other panelists to clarify that any further? All right, Vanetta Young, founder of Vanetta Young Advisors, is working to help create a more diverse and equitable world as it looks at investing, and is working with other communities to help bridge some of the gaps that we see along the lines of diversity, equity, and inclusion. Vanetta, if you want to add anything about your background, that would be great, but also if you could help us really understand better what is non-dilutive capital, what else can people be looking at, what else does everybody need to know in just terms of getting a baseline?
Yeah, I think one of the things to know about my background is I got my start in the private equity space at the Small Business Administration, actually. It's my first foray into the institutional investment space at the SBIC program, the Small Business Investment Company program. It's essentially a government-backed program that helps to fund private equity funds that are supporting small businesses. And I think that having that as was my first introduction into the world of private equity and venture capital, I think gave me the sense of learning what exactly what stage a company needs to be at to consider these alternative investments. And I think in terms of that non-dilutive capital, we're referring to ownership of your company. When someone makes an equity investment in your company, you own less of your company now. And so one of the things that I would think that most business owners want to do is keep as much of their company as they can. One of the ways to go about doing that when you are looking for funding, and it's something that Jim and Ernie have touched on so far, is not every business is going to be suited for the venture capital model. And one of the things that companies, particularly those that are starting out who might have more capital intensive models, should actually consider bank loans, SBA loans. There actually are certain grant programs that one should consider as well. So those are sources of non-dilutive capital in the sense that they will give you funding and still allow you to keep your company. And one of the things that I work with my clients, and my clients are private equity and venture capital fund managers who will be fundraising soon. One of the things that I work with them on is, thinking about what their investment strategy looks like and what are the kinds of companies that they would be best suited to invest in. And so some companies that are considered, that in the venture capital world, it might be considered a little pejorative, but lifestyle, that's a company that's not going to return, 10 to 20 times their investment. So if you do have a company that's not likely to return more than 10 to 20x, you might actually want to consider these non-dilutive types of capital.
Yeah, that's very helpful. All right, and finally, Wylee Runstad, who is with the vice president of a group called ScaleCo, is going to talk to us about private equity and what that means.
Sure. Well, thank you everyone for including us from ScaleCo. So we're a small private equity shop out of Cleveland, Ohio. We actually sit in a really interesting niche that kind of helps us have something to say here, that we don't just do investments that have 2 million plus in cash flow, which, we're all trying to grow businesses and trying to get to that next level. And we might not be there at that stage just yet. So ScaleCo focuses on companies that are around 500K in cash flow and growing. And really what we specialize in, and what my specialty in the private equity fund is I focus on organic growth. So my entire role is how do I go into a business that has 500K in cash flow plus, and how do I get that to go to 2 million plus in cash flow in any given year, so I can sell it to the middle market, which is a very well understood, well trod market of very sophisticated investors that are very interested in that cash flow number and the number of contracts that you have. As long as you've got those two things, you can probably find a private equity buyer that has interest in as an investor. So that's kind of where we sit. And honestly, we partner a lot with Vanetta because when we're looking at a company, probably the biggest thing that I want to get across today is obviously I have interest in companies that are already making 500K in cash flow. But in order to create future investments for our fund, we're also very interested in helping people get to that 500K number. So we end up working with a lot of founders, a lot of inventors, people that have an idea that we think can get to that next level. And honestly, some of our best investments have been those that we've helped mentor people up to the stage where we could make an investment. And we're very focused on that. And some of our best ones have been where someone came to us with an idea and they said, we want to do a startup. And we said, well, who's a traditional player in this market that we could help you buy? And then we can use the existing cash flows of that business to fund a new product line or fund a disruption in an industry. A big one in Cleveland is the Accurate Group, one of our best investments. We love talking about that one. I promise I'll talk about some of the not so good ones later, but we always like to talk about our best investment. And that's kind of what I want to get across and maybe help you guys understand is if you have an idea that can disrupt a market, maybe it's best that we partner with a business or acquire a business that is already in the industry doing the traditional manufacturing techniques, and we just augment that business. And I think that's a really big play that is a huge opportunity, especially when we're talking about additive manufacturing, because everything that you guys are doing or trying, we're trying to improve, tweak, or modify or recreate a process that's already been done in a foundry or through some other method. And so taking over some of those traditional players might be the most comfortable way to getting your idea to market.
So Wylee, what makes that one of your best companies? What's special about it?
Well, our exit multiples were fantastic.
Okay.
But really, so like that was
easy to love.
Yeah, I mean, but honestly, it's a great story from a number of. So the company's based in Cleveland, Ohio, and what they did is nothing to do with additive manufacturing, but Accurate Group basically was a software platform that helped banks interact with their appraisers, which they happened to create that idea in 2006, right when banks were no longer allowed to pick their own appraisers. So we timed the market really well, but basically they're the matchmaker between those groups. And that company went from, one server in a closet with a tarp keeping the rain off of it to now we employ a couple hundred people in Cleveland. Or well, we don't, but the middle market private equity fund that has taken that investment has created that many jobs in Northeast Ohio, which ScaleCo is located in Cleveland, but Northeast Ohio is near and dear to our heart. We try to focus on investments that we can drive to because we're super involved. And so those are some of the reasons why that was a huge winner for us.
All right, very good. Anybody else have a particular story that they'd like to share here? I know this is kind of a surprise question, but I'm gonna flip it on its head in a second. But before I ask the more entertaining question, any other really instructive examples that anybody else has of good investments and why they were, and something that other people might learn from? All right, well, then I'm going to ask the question that I'm sure you're going to have a story, and I'm going to give one. So we've got a story of a company located in Northeast Ohio that had really been working on their own, had not engaged with any of the entrepreneurial services programs in Northeast Ohio, and they took a lot of small investments. So many small investments that no outside investor would try to come in because it was just too unwieldy to try to manage all of the exits of the existing investors, and it effectively killed the company. Company's still working, they're still growing, but it's all organic. They can't take any outside investment. So from a YBI standpoint, because we have programs to support entrepreneurship and do a hammer everything looks like a nail, that seems to me like a pretty good reason why people need to be looking at regions or programs that can help support them grow. So give us your best story of things that you saw where things just went wrong, and that could be a good lesson for people in the audience that are thinking about starting a company, things that they should not do as they are trying to move forward. Jim, it looks like you're reaching to unmute.
I am. I'll give a very broad one, not anything with specificity, but you know, one of the problems I see at early stage, whether it's seed to Series A, is there's a new trend in our region, in the heartland, to ask for more money than your pro forma can possibly justify, and to not have an answer as to how you're going to utilize it effectively to mature your business. And the theory around this, so I've been told by many entrepreneurs, is that I don't want to have to raise capital again because it's such a painful process. So my answer to that is, I understand your pain because investors are painful. However, you know, we need to see a logical path and a maturation in your company and funding that matches it. So if you come to an investor and you say, I need $5 million, but really to achieve your next milestone with respect to the company and the valuation, you really only need $500,000. And then you can go back out at a higher valuation and raise some more capital. I need to see that you've thought through that process. So don't tell me you need 5 if you really need 500. And be cognizant about when you're communicating that to an investor, what that says to us. It says to us that you're not going to use the capital that we're giving you in the most, you know, responsible way possible to grow the business.
And before we jump on to and complete this round, can you just explain a little bit more about what you mean by the valuation?
Sure. So I mentioned angels front-running venture capital and private equity. The whole idea around putting in at a very early stage with, you know, high-risk capital with so many unknown variables is that we're buying at a very cheap price relative to the overall magnitude of the opportunity. So if I buy at $1 and Ernie pays $2 and Wylee pays $3, then I've done my job correctly as an angel. I'm trying to create the most frictionless system humanly possible to take a company that is succeeding and pass it through its logical stages of funding. So that's how that plays out. Ernie, Wylee, would you add anything to that?
Yeah, I mean, the only, honestly, I wish if there was is there a digital cocktail hour later for all of the great stories that go in the investing world?
Yeah, right? Yeah.
But honestly, like going off of Jim's point, like for us, and honestly, this is probably great advice for all of you that are in the midst of starting your business. As investors, we all work backwards. We just work backwards from wherever you are today. So like, the only thing that I'm looking at from a private equity standpoint is I know in 5 years I have to do 3x my dollar, every dollar that I invest. And so for us, that means we're going to look at your general ledger and we're going to go line item by line item, and we're going to look at your expenses and your profit and your revenue. And if we don't think that every dollar that we're investing today can somehow get to 3x in 5 years, we're not going to do it. So going to Jim's point of like looking at pro forma or looking at your financials, if you're actually post revenue, we're going to work backwards. And that's where we're really going to take a look at your business at whatever stage it's at. And every investor kind of works that way, to my knowledge. And that's going to be where you're going to get that initial trust factor. So if you come in and you tell me that you need $1 billion, but I look at your financials and you're only going to be making $1 million, I already know the conversation's not going to go anywhere, and you might be depriving yourself of a great learning lesson, if not an investor. Because the one thing I will tell you is that all of us are operating off of the same information that you have access to. We're just operating from the investor's mindset with that information. And the only thing that we have going for us is reps and sets in the industry. I look at 10 or 15 deals that I put in LOIs on and go through diligence with a year. In order to get to those 10 or 15 companies, that means I'm looking at 500 to 1,000 companies in any given year. So like, you want to get past that initial sniff test so you can have the conversations. So don't go in throwing out such a high number that everyone just gives you, it was great to talk to you, but we'll catch you on the next round conversation. get to the next round, get in the room, have the conversations, because once you're in the room, at least you can learn something.
And I would love to hear Ernie's opinion on this too. And I think one of the things that's really important and is part of the nature of this panel was saying, know your audience in the sense of, if you are reaching out to someone for angel or venture funding, know the people that you're speaking with and have a sense of what it is that they're looking for. Yes, there is that kind of across the board. They're looking for companies that are in a certain stage, companies that have a level of organization, but, do your research before you talk to someone because, as Wylee's alluded to, you only get one first impression. So having a really solid understanding of what this group is looking for is going to save them time and your time as well.
And I think that's an important note because every group is looking for a particular thing, a particular state market, a technology focused, whatever. And if you're not aligned with them, you're wasting everybody's time. Ernie, go ahead. I didn't mean to jump in there.
Oh, no, please. I guess a few comments. First, agree with everything that's been said. On the know your audience perspective, understand that I like to draw the analogy to a job search process, right? When an investor first looks at your deck or your summary or whatever it is that you send, they're not reading it in detail. They're spending about 30 seconds on it. And there better be something there that compels them to read beyond 30 seconds into a few minutes, right? And something that compels them then to have a call with you. So don't have the expectation that, by putting a whole bunch of information into a page document, that's what they're looking for. They're looking for reasons to talk to you again. Have you interacted with, Lockheed Martin or IBM or, some, Bill Gates, and I'm being hyperbolic here for a reason, but, give them a reason to very quickly and easily find something on that makes them want to talk to you, more deeply. And secondly, sort of flipping kind of Jim and Wylee's comment to, you can also ask for too little money, right? If I'm talking to an investment that says, oh, I only need $150,000 to get to the next whatever. Well, if we invest that $150,000, you're gonna need to be looking for the next round of capital the next day because $150,000 just isn't going to get that far, right? So you can ask for too much, and not to give the Goldilocks and the Three Bears analogy here, but you can ask for too much certainly, and you can ask for too little. And regards to the financials, if I had a nickel for every set of financial I looked at that, right, especially at the early stage, didn't include utilities and telecom and all of these little things, and you ask the question, well, why weren't they there? Well, they're all little and they're not going to be meaningful. Well, when you add them all up over a year, 18 months, whatever it is, they're very meaningful. And if you've, assume that your rent is a half of what it should be and your telecom costs are half, that's going to make a big difference for when you're going to need a next round. So, just adding on a little bit to all three of the previous comments, which I think are some helpful thoughts.
Hey, sorry, Barb. The one other thing, building off of Ernie's point, I wanted to jump in. Sorry, I'm always the guy that talks too much. As investors, making sure that actually look like something real is happening. The other side of that for all of us, because we're all what's called value add investors, is we want to know how we fit into what you're doing. So picking the right stage, picking investors that you're saying, hey, I want you as an investor because you do this in this company, or this fits your thesis, or this fits the industry that you're in. If you can connect the dots, you're a lot closer to that second conversation, because that's what gets their minds going, especially for us in private equity. Like, I can be doing platform investments or I can be doing add-ons. If I know how, and the difference there is a platform is like, this is my first investment in this vertical, I'm going to build around this. Or add-ons, which is I'm going to take this business and plug it in with this business to get a bigger business. If I know how you might fit with those things, that gets you a lot closer to that conversation. We're going through this all the time. Every time we're having a conversation about every deal is, could this be a platform or could this be an add-on? And honestly, with every private equity fund, most venture funds, and everyone in between, you can go on their website and we put the logos of all the companies that we work with. So if you're like, that guy right there on your website does that, and I can do this, and the two of us can work together, the light bulbs start going off. The more of those stories that you can tell us, the faster you're going to get to that second conversation, to that 3-minute review. And that's where you need to get, because that's where you start learning.
Just taking one of the questions from the audience and tweaking it a little bit, because I know it's rather specific to additive, and I'm not sure we have enough information really, because it's really a fairly new technology. But have you looked at this technology deeply enough to be able to say what revenue multiple is the standard for this industry? And if not, first off, could you give a good explanation of what that even means? And how would somebody start to try to determine that if they were looking at their own financials and how they were going to do a projection?
I know how I'd look at it.
Okay.
So like, my best recommendation is honestly, I don't think that you can come up with that revenue multiple yet for additive, because the industry is just too new. And I mean, honestly, additive's been around it's actually been around for a while, but we're still just trying to figure out what processes it can disrupt. And for me in private equity, where I'm working with later stage companies, I'm going to compare it to whatever you're disrupting. So whatever process or product that you are making the argument that you're going to disrupt, I'm going to go try and find a comparable for that and look at its expense profile, its labor profile, all the way down through the financials. And then I'm going to look at what you say you can produce that for, and I'm going to compare it there. And then now I'm going to build an entire model around if that company is going to make sense at a multiple that I can actually get 3x my money in 5 years. So like, again, we always work backwards, inventors work forwards, right? That's the major crux of why there's sometimes a disagreement between us. But for us, that's where I would actually start. And any information that you can provide as the company that's pitching me is going to help me get that mindset. So if you can tell me the actual specific process that you're disrupting, that's going to help me draw that financial model together a lot faster and get me a lot more interested.
Jim?
Yeah, I'll add on to that. So right now, when I look at additive deals, I'm giving them a multiple that corresponds to industrials. But at the same time, I'll give you an example that happened just a few weeks ago with an additive company we looked at. They were playing in the aerospace supply chain, and what they were doing essentially is establishing part provenance and printing on site for rapid delivery of actual usable parts. And in that particular case, in that use case, I'm going to give them a different multiple outside of the depressed industrials, and I'm going to then apply an aerospace multiple to them, even though they're just fitting into one segment of the supply chain. So I say all that to say this: your revenue multiple is going to be, to Wylee's point, specific to who are you disrupting. So go out and look at the industry vertical that you're looking to enhance, and then there are multiple sources, and I honestly use New York Stern School of Business. They publish some really good multiple numbers that you can pick up by industry vertical. Go out, take a look at those, and figure out what works for you based off of the space that you're disrupting.
And honestly, to add to that, Jim, a lot of times if you can find a company that is doing the traditional manufacturing process and you go have a conversation with them, you'd be amazed what owners will tell you.
Oh, yeah.
You'll also be amazed what other investors in an industry will tell you. If you can find a PE investor that's in an industry that you're disrupting, they'll have a great water cooler conversation with you And again, like that's kind of what I was getting to. You have access to the same information that we do. We just know that people are willing to answer questions if we ask. And a lot of our job as investors of capital is going and asking those questions. And that's all we do, is basically go around and try and learn every day. And that's something that you might not have time for, or feels like you don't have time for, but even one conversation can get you put on the right track.
To be fair, though, we do a better job finding comps.
Vanetta, do you want to add something? I see you shaking your head.
There's the unmute. No, Wylee just got me thinking about, you know, the of networking in a context like this kind of can't be understated in terms of not just getting information, but also developing relationships with folks who either can put you in touch with people who can invest, in addition to just giving you the additional education and information. So that was just something that crossed my mind while Wylee was speaking, is, you know, reaching out to people, not just because you need capital, but because you need information and because you want to develop a relationship that might pay off in the future.
So jumping off of that, let's talk a little bit about market validation, because we hear so frequently that, you know, everybody has the next great idea, but it's not necessarily one that somebody's going to pay for. And we work very hard to try to get our companies to understand that you have to be solving a problem. So what do you look for in any type of market validation, and how deep are you going to double check everything? Wylee, you look like you have something to say.
I will say that probably in the capital stack in your series of investments, it probably, the farther into the stages of a business you get, the more intense this gets. So, you know, for us, diligence on a company lasts 90 days. And that's 90 days of us tearing into every single detail, including talking to your actual customers, pretending to be a customer, getting to talk to your frontline employees. And again, like when I said we look at your GL, by the time we actually write a check for acquiring a business, our team of analysts will know every single line item on your GL, and we'll be asking you about where you used your Amex points. It's not fun for anyone, and we apologize up front for doing it to people. So for us, market validation is honestly, we look at historical performance. So for any private equity fund, us or anyone else, we're going to look at 3 years. Or if you're don't have 3 years, we're going to expect a really significant amount of growth. But we're going to look at 3 years of cash flow, and we're going to model from that. So our financial models that we build during diligence, it's 3 years, and then we just extend your GL, every single line on your GL for 3 years, 5 years into the future. And that 7-year window, if we see this, it's not going to work. We want to see a nice steady line of growth that gets us to the point that we can aim for something. So, I mean, we're probably the most intense and the least fun. But yeah, I'll turn it over to everyone else.
So I'll give the angel perspective. Oh, go ahead, Ernie. Go ahead, Ernie. Oh, okay. So from an angel perspective, you know, when you're really early and again, we're taking that high risk bet, anything that you can do to demonstrate pent up demand with action is going to serve you very well. Now, what does that mean? Well, you know, don't tell me names in your pitch deck of people that you think might like your product. Bring me memorandums of understanding, letters of intent, things that document in a very hard way that if in fact we fund you and you reach the next level of your company's growth, you have pent up demand sitting there that you need to fulfill. Because if you do that at the angel stage, by the time you get to Ernie, you're making his job much easier, because now he can see that there's even a larger market that his larger capital base can help you grow into. So that's what we're looking for at the angel stage. If you just put names on your slide deck, it's not going to do you any good. Ernie?
That's a great tee up in that, I mean, you know, we're looking for those initial customers, right? And have they written checks? how big were the checks, right? I mean, there's a big difference between an unpaid pilot and a paid pilot and an actual customer contract, right? So, you know, and bigger companies extrapolate generally to bigger markets, right? I mean, if you've got a very large manufacturer as your customer, right? I mean, hey, you used IBM because this is additive manufacturing, but there's a reason for the go with IBM term, right? Big brands, big companies extrapolate to big checks in big markets. Not to say that you can't have validation with smaller companies, you absolutely can, but then you need more of them, right? I mean, because it's going to require smaller check sizes to get to the larger returns that we require. And the other piece that we look at is what other types of companies in your market space have been funded by other venture firms, right? You know, once you've gotten beyond Jim's angel stage, right? You're hopefully not creating your own market. In some cases, that's the situation. You are creating a new market, but ideally, the market's already started to form. And if that's the case, you know, other investors have probably entered it, and there are probably other venture financings. So we often look to sort of our brethren nationally and see what's going on in a particular market, who's being funded, how much, what are their value propositions compared to the company we're talking to, and so forth and so forth. So it's an investment market validation, so to speak.
Honestly, Ernie and Jim, you guys are like right on point. Like the other thing I'd say for all of us is like a recommendation here is how many customers you think you're going to add, how big those contracts are going to be, how many of them you think you can retain and for how long. If those are all things that are built into your projections, that all gives us all comfort, because what we're going to do is whatever projection you're going to give us, we start by dividing it by like 75%. And if that number still makes sense, we divide it by 80. If that still makes sense, we divide it by 95. And if that number still makes sense, then we want to have that conversation. And like, if we see you having those thoughts in your mind, it also gives us a lot of ease with the management team. And this is, I think, applies at both angel and VC as well, is we're trying to assess you as a person, your team, as people that are having these downside conversations, because we don't want to be the doomsayer, and we don't want you to be mad at us when we do have those what's the downside conversations. And that gives us a lot of confidence in the team as well, is to know that you're having that is like, hey, I think I can do this, but this still works if I can do this. It still works if I can do this. And it still works if I can do this. Because we get to say that to our investors. We say, we've got your capital invested. We think this can do 12x, but you're still good at 3. And that makes our investors happy.
Vanetta, you want to jump in?
I was going to say, just given the kind of rumors that Jim, Ernie, and Wylee have laid out, if you're too early for all of these, that's where your non-dilutive capital is going to come in. I think early stage entrepreneurs often don't think about bootstrapping, or they do think about bootstrapping as the kind of struggle until they get capital. At the same time, I think there is so much validity in bootstrapping in terms of, you know, showing skin in the game, as the industry calls it. But I think if you are very early and you're like, well, where do I get the capital to get the validation? That's where that non-dilutive and bootstrapping is going to come into play, because as you can see, there are a lot of standards you have to meet when you're actually going out to get capital from other people.
And honestly, Vanetta, I'm going to prompt you a little bit, but if you're in those early stages, this is where, like, if you don't know what the SBA 504 and the SBA 7A program are, there are people that can help you understand those programs. Yeah. And again, that is non-dilutive capital. And honestly, I wish I had used those programs over the last like 2 years, because the government just basically paid like 2 years of everyone's payments on those programs for buying businesses. Great time to be an SBA like partner right now. And I think there's going to be more of those types of fundings, but like Vanetta can talk a lot more about those programs. So I'm going to let her take over. But if you're at those early stages, those are programs that you should know what they are.
No, definitely. And I think because for full context, live in Washington, D.C. And so sometimes I get a little swept in the wind of all the things that wind up changing, but definitely the SBA is going to be your best friend for sources of non-dilutive capital, and definitely keep yourself posted of what they have, all of these different programs that they have going on, because they do come and go as Congress does.
And just to throw in there, you don't have to know them yourself. You just need to know how to access them. So there are organizations like YBI and many others that can help entrepreneurs find their way through those mechanisms, and not just with the SBA, but with Small Business Innovation Research grants and STTR grants as well. So you really need to understand the economic development platform in your community as well. So we are running out of time here real quickly.
I think a bunch of investors together to talk about investing.
And they talk. We already talked about this a little bit earlier. One piece of advice, if you could talk to people in the audience who are thinking about starting a business or developing a new technology, what would be the one thing you would want them to walk away from with this today?
I'll start if you want.
Yeah.
And we touched on this earlier, and I say this constantly to entrepreneurs that I interact with. Do not waste your first interaction with capital. And what I mean by that is that, and Vanetta talked about it earlier, do your homework. Don't talk to capital that doesn't want to invest in you from a thematic standpoint, from a geographical standpoint. Don't waste that first interaction. Don't test a suboptimal pitch deck on your first venture capital call. Don't do any of that. Your first interaction is the most meaningful, and you need to be absolutely prepared for it. And if you're not, don't do it. So that would be my biggest takeaway, because I see entrepreneurs, really promising ideas, really promising teams, fail to raise capital because they don't appreciate the importance of that first interaction.
Vanetta?
I think I would also emphasize the do your homework and know your audience, and know your own business, and have a sense of how much ownership do I want to give up? You started this business for a reason, presumably. How much of this do you want to give up? Non-dilutive sources of capital might actually be what fits best for your business model, but frankly, emotionally might feel better for you than giving someone a piece of your business. And this sounds like it can be exclusively a business decision, but it's not always, because this is something that you started and it needs to feel right to you.
Wylee?
So I've got two. So my first one is always take a look at non-dilutive options. Like the only reason that people don't do non-dilutive normally is the personal guarantee, especially when they're a startup. Are sometimes, and if you talk to people like Barb, or if you come talk to me or someone like Vanetta, or really anyone on the call, there are non-personal guarantee options out there for startups. They're rarer, but even if you are going to take a personal guarantee, there are ways to structure that risk and box that risk for you as an investor, and not just as an inventor or a entrepreneur. There is collateral. Buildings stand before your personal guarantee. All sorts of other assets that we don't have the time to get to here stand before your personal guarantee. And so you can box that risk really well, and you can use that instead of giving up equity, because you only get to give up equity once. So that'd be my first big one. The other one that I would say is going off of do your homework. You would be surprised at how often, if you just call people for information, they'll give it to you. So again, don't be afraid to call investors in an industry. Don't be afraid to call VCs and say like, hey, you invested in this company. It's sort of like what I want to do. This is what I'm doing. Can we just have a conversation about why you picked that investment? Those conversations will pay dividends. And honestly, I help a lot of people where I don't invest in certain industries, but I liked the way the team reached out to me, and I'll help them find the right investor. And like, if you can get into those networks, because we spend all our time networking with other investors, if you've got one guy that's willing to vouch you over to another VC, another angel, or another private equity fund, or a non-dilutive partner, because banks love getting referenced deals, that will pay dividends. Like those, there's just no, it's completely invaluable.
All right, and Ernie?
I've got, 3 here I've been debating.
Okay, I'll give you all 3. It's okay.
Dovetails a bit on the doing your homework piece. Absolutely agree, no doubt about it. But there's a deeper reason, and the advice is, as silly as it may sound, your investor materials are not a sales pitch, right? And what I mean by that is a lot of entrepreneurs will put a lot of hyperbole, right? The greatest next thing, the best this, and it comes off kind of used car salesy. That's not what investors are looking for. And they're looking for, you to do your homework and provide these materials, not because it's a checkbox to get investment. It's because it's good business sense. You should have done your homework. You should have explored your market. You should have put together good financials, right? Investors aren't looking to them because they're trying to walk you through a process and there's a golden ring at the end. It's because that's what they would do if they were starting the business and what they would want to know. And they want to know that you know it, right? So there's a reason for the homework. It's as much about having done the right personal analysis of your business as it is other. The second thing is, don't view venture capital in particular as the way you validate your business, right? You could have the best business ever in $100 million market and VCs won't touch you. But you know what? If you could tell me that I could own a $100 million market by myself, I'd quit what I'm doing right now and go do it, because that's a great business for me personally, right? And then lastly, venture capital, and this is, I'm the venture capital person here, I want to focus on that. It's not for everyone, right? Even if you don't give up controlling interest in the business, there are going to be provisions that allow the VC to, the VCs and investors to really manage the company. You're going to become an employee, right? An important employee, but you become an employee. And there's a big difference between being an owner who reports to yourself and being a CEO that reports to a board and a set of investors. And that's not for everybody. So you really need to think about whether that type of investment's the right program for you, because it's not for everyone. So anyway, hope that's helpful.
And I will throw in one last one, which is to have a very clear understanding of what problem you are solving, because you can have the greatest technology in the world, but if it's not solving an actual problem, then nobody's going to adopt it. So with that, John, I see you've jumped in here. It's time to wrap up.
Wrap it up. All right. Well, thank you all. Really appreciate all the diverse perspectives. This is something that honestly we haven't really addressed at the Institute before, perspectives that we brought to the community. So really appreciate your diverse perspectives.